Welcome to Daybreak Australia. I'm Paul Allen in Sydney, where markets have just come online.
I'm Annabelle Droulers in Hong Kong. We're counting down to Asia's major trading opens and our top stories this hour. China to halt the lending of some shares for short selling in a bid to support the country's slumping stock markets. The earnings spotlight turning to Japan's big banks, whose trading income probably fell as traders await any BOJ move to end negative interest rates. Plus, Intel's boss calls the chip maker's worst stock sell-off in 3 years overstated. We hear this hour from CEO Pat Gelsinger. And taking a look at how oil is coming online, of course, Monday, the start of trading here, we see Brent crude, WTI coming online at the same time. We are seeing those prices here just jumping fairly modestly because we're just over 1% for each of those contracts here. But still, the move really a reflection of those events over the weekend. So we had 3 U.S. troops being killed by what's believed to be Iran-backed militants. We have traders really recalculating their Red Sea risks off the back of that because we had the response from the US so far saying that they are vowing to retaliate, will be vowing to hold all of those responsible to account at a time and in a manner of our choosing. So they were the words of President Joe Biden in a statement. But that is the market reaction we're seeing today so far. Brent crude, WTI, both of those moving here to the upside. Let's change on, though, because we've got US contracts coming online for futures here, and it is a big week ahead. We've got the Fed rate decision, of course, on Wednesday. Our focus is when we can expect to start to see any sort of rate cuts, how they're likely to be signalled to the market as well. So focus on what Jay Powell says in that press conference after, and a big week ahead for earnings. Not just in Asia, of course, Paul, but we've got more Mag 7 numbers on the docket. Microsoft, Apple, Meta, Google, Amazon. So really big numbers ahead.
Yeah, well, we're just getting going here in Australia, of course, returning to trade after the long weekend. Right now, we've got a little bit of weakness on the ASX, but of course, we have the staggered open here. So let's wait and see what the morning brings. Meanwhile, not a great deal of change in the Treasury space in Australia. The 10-year still hovering around that 4.2 mark, and the Aussie dollar still just below 66 cents US. We will have Japan opening at the top of the hour as well, the next hour, that is. We've got Nikkei futures modestly in positive territory at the moment. The yen softening again as well, 148 against the greenback. And if we take a look at futures for China as well, also modestly in positive territory as well. And we did see Chinese equities closing out the week a little bit better than in which they began it, but some of that rally did seem to be losing a bit of its shine, Belle.
Yeah, certainly want to be tracking how long it can last here, but we are still getting further steps from officials in China to support the slumping stock market. So now the latest is that they're halting the lending of certain shares for short selling. So let's get more on this now. Our Chief North Asia correspondent, Stephen Engel, joining us in Hong Kong this morning. So just talk us through at a headline level, what do we know out of these announcements?
Well, obviously, let me take a step back. We all know about what the Chinese markets have done so far this year. The MSCI China Index down about 60% since that February 2021 peak. And, of course, there's been a number of steps. Last week was a fairly good one in retrospect and in basically in comparison to the rest of the short year already. It was the first weekly gain for the MSCI China Index so far this year. So they're trying to put a floor. Now, this latest step that you just mentioned, again, you know, Chinese regulators, as you know, they've never really been too kind towards short selling anyway. But right now, what we saw in October, essentially, limits were put on the lending of shares that executives and other strategic investors, or employees, I should say, get in what are called strategic placements, and other curbs were put in place. Now, the CSRC, the securities regulator, essentially in their statement over the weekend, essentially said that these particular stocks that were lent by strategic investors, they've dropped about 40%, according to the CSRC. So now what China has done is they're essentially halting the lending of these particular certain shares for short selling. As of today, strategic investors won't be allowed to lend out those shares as well during this agreed-upon lock-up period. So, again, it's just another step to try to put a floor on the falling stock market, restore confidence, and we'll have to see how well it works. As Paul alluded to, you know, some of these steps seem to be petering out towards the end of the week.
Yeah, well, we had industrial profits for the month of December out of China over the weekend, of course, Steve, still in contraction. But what are they telling us about the health of the economy in China?
Well, we know that there's a deflationary environment. We know that there's weak internal demand and weak external demand. We all know that. Those are the fundamentals. But if you look at the trends seem to be improving for industrial profits, even though the numbers for the full year down 2.3% overall for the largest industrial giants in China, and that's a year-over-year basis. But you saw a pickup in November in particular with a 29% gain in industrial profits and in December. So there was a late year surge for industrial profits. I think, December was up 16.8%. November, 29.5%. But overall for the year, it was lower, down by 2.3%. The reason there, again, base effects. Year over year in November and December, we had COVID spreading through China in 2022. Late 2022, factories were closed. So those numbers are going to be a bit skewed. Overall, the general trend since October, it's been an improving trend of industrial profits. We saw factory output expanding 6.8% in December, the fastest pace since 2021. So that's an encouraging sign. And year-over-year decline in PPI, Producer Price Index, also slowed from November in December. But again, the overall background is a deflationary environment, weak external, weak internal demand, but industrial profits, as they're starting to wind up the destocking process at many of these big industrial giants. So that will start helping improve profitability.
All right, Chief North Asia Correspondent Stephen Engel there. Let's take another look at how the oil price is performing. We're seeing moves of greater than 1% upwards for both Brent and West Texas at the moment. WTI now just above $79 a barrel, Brent at 84.68. And this is, of course, on the news of that drone strike near the Syrian border that killed 3 U.S. troops. And President Biden has vowed retaliation after that attack. It was tied to Iran-backed groups. 3 U.S. troops killed, as I mentioned, 25 others wounded, and this happened in Jordan near the Syria border. So for more, Bloomberg's Michael Heath joins us. So, Michael, retaliation is anticipated, but there's going to have to be some sort of discretion around the scale, right?
Yeah, that's exactly right, Paul. I mean, we're going to be talking about calibrated attacks. One of the advantages of having a president Joe Biden's age is he's seen the risks of becoming too heavily engaged in foreign policy battles, struggles, wars, etc. So whether they hit back at Iran, I mean, they'll have to do something significant. This is the first US soldiers to die since the conflict, and obviously 25 wounded. It was a significant attack. Those troops are based there to fight Islamic State, so they weren't really part of this conflict at this stage, but we'll have to see something from the US. The Republicans are obviously baying fairly hard. We had Senator Lindsey Graham talking about hitting Iran. Whether that happens, it seems unlikely. President Biden, remember, withdrew US troops from Afghanistan under controversial circumstances. He's not big on getting engaged, getting bogged down in regional conflicts, and that's been one of the hallmarks of his response to this targeted attacks, providing support, using diplomatic pressure, but not having boots on the ground. And obviously everyone in the US would be mourning, there'd be a lot of anger, a lot of desire for revenge, but Biden is likely to be very, very careful in what he does here.
Yeah, well, I guess it really comes against the backdrop as well of what the US is hoping, that we see some sort of hostage deal in place.
That's right, Annabelle. It's very interesting news coming out. So in Paris on Sunday, there was a meeting between the intelligence chiefs of the US, of Egypt, of Israel. We had Qatar's Prime Minister there. And the talk is that we're getting closer to a deal between Hamas and Israel. The length period discussed is 2 months. And the idea of that is to bridge this gap where 2 months is long enough for Hamas to sort of be able to claim that hostilities are at an end, and Israel to be able to sell that it hasn't stopped the fight, but it gives a protracted an extended period when these hostages could be potentially brought out and more aid brought into sort of a catastrophic civilian situation there in Gaza. Now, both sides, there seems to be a degree of optimism. Now, how long it takes, there's talk of days, there's talk of a couple of weeks, but there's still obviously 100 hostages that are being held in the enclave at the moment. But this is the strongest news we've seen that something could be afoot. Obviously, it's been November 30, the last truce that lasted for about a week ended. So we've had a long period there of conflict, and there was increasing worries. There's been a lot of pressure on the Israeli government to try to do something about these hostages, and this seems to be the closest that we've gotten to. Until we actually see, a deal in place and fighting stop and hostages move, you wouldn't want to trust it. But these are very, very positive signs we've seen.
All right, Bloomberg editor Michael Heath there. Some other geopolitical stories that we're watching around the world. North Korea fired several cruise missiles on Sunday as leader Kim Jong-un ramps up his rhetoric about a potential conflict with South Korea and the US. South Korea's military says multiple projectiles were detected near the North Korean port city of Shimpo. Kim has ignored US calls to return to long-stalled nuclear talks, which offered economic aid in exchange for disarmament. The US says top officials have discussed scheduling a call between Presidents Joe Biden and Xi Jinping sometime in the next few months. It's the latest effort to maintain high-level contacts that were revived after the presidents met in California in November. We're told US Secretary of State Antony Blinken is also expected to visit China again this year. Bell.
Well, still to come, that focus on China's property sector as well, because Evergrande once again trying to fend off liquidation at a court hearing in Hong Kong. Certainly something we're tracking later this hour, those court proceedings. But first, Evergrande's May Wealth shares their outlook on US stocks as traders await more earnings from the Magnificent Seven. We'll have more on their market strategy next. This is Bloomberg.
You're watching Daybreak Australia. Here's a look at the week ahead. The Fed will make its first rate decision of the year. Bloomberg Economics says while the FOMC will hold this week, the stage is set for a cut at the March meeting. Focus will also be on the US labour market with the jobs report and JOLTS print, both due. Here in Asia, we are less than an hour away from the first decision by the Monetary Authority of Singapore since it switched to quarterly meetings and the departure of longtime chief Ravi Menon. Other central bank decisions that we're watching this week out of the UK, Pakistan, Brazil and Chile. And on the data front, China's PMIs are expected to paint a slightly less bleak picture ahead of the Lunar New Year holiday. Annabelle.
Well, Paul, this week's also the peak in Asia earnings season with 162 firms on the MSCI Asia Pacific Index reporting, including Japan's megabanks Nomura, Sumitomo Mitsui and Mizuho. In the US, AI investment, regulatory challenges, the waning demand in China, they're going to be the focus as 5 of the so-called Magnificent Seven post results. That's Microsoft, Alphabet, Meta, Amazon and Apple. Meanwhile, Boeing is expected to snap a 5-quarter streak of losses. But the plane makers' executives are going to be facing more questions about how they plan to allay concerns over the quality of their aircraft. And that is your week ahead. Well, let's discuss that now with Brooke May. She's managing partner at Evans May Wealth. Brooke, it's a really important week for US tech stocks in particular. It's already a very crowded trade, perhaps, but do you expect to see more earnings growth, perhaps, as well out of these numbers?
We do. We are still big fans of big tech and think they'll continue to be leadership in the market. But we believe there's really a bifurcation going on right now where you can't just buy the broad market. You have to be very selective in the names you're picking, and big tech are some of the names that we think will do well.
Are there any specific names in big tech as well? Because Microsoft, for instance, the story last week was it hitting $3 trillion.
Yeah, we like Microsoft. We own Microsoft in our portfolio. And we really own all of the Magnificent Seven companies and believe that they all should have strong earnings going into 2024. But we're also picking up on some companies that didn't necessarily do as well last year. One is Taiwan Semiconductor. When you look at chip sales, they were down 9% in 2023. And we expect them to be up 13% this year. Taiwan Semiconductor being one that we think will be dominant. They're obviously very large and have economies of scale that will benefit them. But they're also getting into generative AI. And we feel like, like most investors, that's the place to be. And so we're looking forward to seeing good results out of Taiwan Semiconductor in the months ahead.
Are there any other names that you're watching in particular in the chip space? Because, for instance, we had the results from SK Hynix as well, indicating the sort of revenue that they were generating from their own AI potential.
We like NVIDIA. While I know they surged and were one of the best performing companies in the S&P 500 last year, they're still our top pick, and we have our largest allocation to NVIDIA in our growth portfolio. We think that they're a dominant player and have quite a bit of an advantage when it comes to AI chips, and so they're our top pick in that space.
Of course, Brooke, one of the features of this rally so far is it has been quite narrow, confined to a lot of those big tech names, a lot of the AI space, and we've seen small caps are really underperforming. Do you see this rally broadening out, and are there any names in the small cap space that you'd consider adding?
Right now, we think you have to be careful when you look at small caps. Obviously, they had an amazing rebound off of the October lows, but they've given some of that back in the last few weeks. And we think that with small caps, it's going to be hit and miss in the near term. When you look at the Russell 2000 and you look at small cap companies, about 30% of their debt is at variable rates. And S&P 500 companies, only about 6% of their debt is at variable rates. So 40% of small cap companies are not profitable and need that debt to operate. And that's going to be quite a hindrance on earnings and being able to grow as a small company. So while there was an 80% probability that the Fed was going to start cutting rates in March, now that's a 40% probability. That impacts small cap companies. So we don't think it'll be until the summer or maybe the second half of next year where we see rates start to come down and smaller companies benefit from a little bit of easing there.
Yeah, let's talk a little bit more about that. Of course, the Fed decision this week, no one's expecting any movement for the key rate then, and you just talked about expectations around March getting scaled back as well. But in terms of the timing and also the number of cuts, have you changed your expectations?
We've been in the camp that it's going to be lower or it's going to be higher for longer. We would expect the first rate cut to come in maybe May or June, and maybe only 3 rate cuts this year. Again, investors were expecting rate cuts to start very early in the year and potentially 6 or 7 cuts throughout the year. And we don't think that's going to be the case. If the labor market remains very strong, we think that the Fed will be patient. The Fed was predicting a 4.1% unemployment rate for 2024. And if we stay below that number, there isn't the urgency to come in and start cutting rates. They can be patient and they can wait for clear signals that inflation is under control, it's tame, and it's at that 2% level that they're looking at.
Yeah, the data's look pretty strong out of the US. How confident would you be in saying that the recession risk is now all but gone?
We think that we think that a significant impact to the economy is off the table at this point, assuming nothing unforeseen occurs. We think that it's more kind of a rolling recession where we've seen manufacturing decline, we've seen housing decline, and different pockets of the economy are being impacted at different times. We're starting to see the consumer take down their savings, but we believe that they're going to operate on credit. And as long as they have unemployment, they're going to feel comfortable spending. So that's going to keep the economy strong. We don't see that changing anytime soon unless unemployment starts to tick up. So really, the economy's been driven by the consumer, and we see that being the case for the foreseeable future.
All right, Brooke May, we'll have to leave it there, but thanks for joining us. Brooke May is Managing Partner at Evans May Wealth. We have plenty more to come on Daybreak Australia. This is Bloomberg. You're watching Daybreak Australia. Sources say the US is aiming to announce major chip grants by the end of March, aimed at supercharging domestic production. The awards are slated to go to Intel and other US chip makers, as well as foreign firms, including TSMC and Samsung, to help them build factories in the US. Money from a $39 billion bill that President Biden signed into law more than a year ago has been slow to trickle out, with only 2 small grants announced so far. Intel CEO, meanwhile, is trying to reassure investors that the company is on track to make a comeback. First quarter sales and profit forecasts fell well short of Wall Street estimates, and that sent shares tumbling the most in more than 3 years. But Pat Gelsinger told us that the market reaction went too far.
First, we finished a great year. We had Q4 beat on top and bottom line, finishing a year that was comfortably ahead, and showing the transformation journey that we're on. And we believe we're putting points on the board for a long-term transformation of this iconic company. In light of that, hey, the Q1, at the low end of seasonal. So we think the market reaction is a bit overstated in that respect. We understand it, but our company, our employees are doing an incredible job at delivering our process technology, restoring product leadership, defining new categories like the AI PC. We're on a multi-year journey, and we're not going to be judged on a 90-day shot clock. We are out to rebuild this company, and we had a great 23, and I'm confident in a great 24 for this company.
Pat, there were so many questions on the call about your foundry business, and for our global audience, that's the sort of contract manufacturing business where you make chips for others. And you seem to say that you didn't get as many committed dollars as you thought you might. And I wonder what's standing in the way of that, customers committing to backing your foundry business.
Yeah, and we're very comfortable with the progress. We said that we'd have one on our leading edge node, 18A, as it's called, and we delivered 4 for the year. We also found that there was a lot of momentum in our packaging business, where we now have 5 major customers on our advanced packaging technology. And we said, hey, we went from $4 billion to over $10 billion of lifetime deal value. So good momentum. But most importantly is the process technology itself. Are we back to a leadership technology? And we're hitting all the milestones, this audacious 5 nodes and 4-year plan. And all of the milestones are on track to have us back to process leadership in 25. And as I say, a foundry company, they want to know that if they design on us, they can build the best products. And we're gaining momentum in delivering on exactly that promise. And so proud of my teams for delivering on such an audacious plan. We're on track.
What about track for AI accelerators? Not just AI on the PC, but I put it bluntly, Pat, NVIDIA's run away with this. When or can you regain any sort of leadership in that space?
Yeah, and clearly that's been an area of strength for them. We appreciate that they've, as I say, focused on that for many years, and the market has come their way in a strong way. But our roadmap is gaining momentum. Gaudi 2, we said we're seeing a significant expansion in the customer pipeline that we have. We're ramping up supply. So I'll say we're chasing to have enough supply, to meet market. And we're well underway on our next generation, Gaudi 3, as it's called, with 4x the compute, 2x the network, in the lab, gaining really, really good early debug in bringing that product to market later this year. So we feel like, hey, yes, we have a lot of work to do here, but the momentum is building, the market is looking for alternatives, and our roadmap is strengthening as we go through the year. But more importantly, Carolyn, is this idea that last year was the year of high-end training. This year, it's about how do I use those models? And that's much more about the enterprise strength where Intel is at the edge, in the PC, and in the enterprise data center. So we see the market coming our way in AI in 24 and 25.
That was the Intel CEO, Pat Gelsinger, speaking to Bloomberg Tech's Ed Ludlow and Caroline Hyde. Well, coming up, debt-laden property developer China Evergrande is facing a renewed risk of liquidation in a court in Hong Kong. We'll have that and more on China's property crisis next. This is Bloomberg. You're watching Daybreak Australia. Just taking a look at what we're seeing in the bond space so far. Futures online, and we're seeing them climbing here across the board. So it does tell us perhaps there is a bit of move into haven trades. We are as well seeing oil prices rising this morning. That is after the US said that Iranian-backed militants killed 3 service members near the Syrian border at the weekend. So just waiting and perhaps recalculating those Red Sea risks and what it means for those tensions in that part of the world. As I said, it is perhaps that sort of move, but the other part that's playing into it is what traders are thinking around their expectations for the Fed, because we're due to get another rate decision later this week, and Bloomberg opinion columnist Mohammed El-Arian says the US central bank's job isn't over yet. That's even as inflation begins to ease.
we are in the sweetest spot of the inflation reduction right now. It's going to get tougher going forward. And we've already seen from Europe that it's not out of the question that not only does inflation stabilize, but once in a while you get the rate going up. And that would really impact perceptions.
The White House is so excited to lean into this, Mohammed, very soft landing expectation. The timeline may be on their side, but when you look out to November, where are the vulnerabilities to that soft landing?
So the vulnerability, there's three of them. One is what the external world is imposing on the U.S. It is getting harder to grow in this global environment. We have disruptions of supply chains. We have cost pressures in the pipeline. We have delays in shipments. All that has a marginal impact. Two, the consumer is going to be under more pressure. You've talked about debt levels in the previous hour. Savings have come down. We no longer have the pandemic savings being utilized to the extent it was before. So there's a real risk that growth slows to the 1 to 1.5% level, with downside that we may slip into a negative quarter. And then thirdly, inflation. We need inflation to keep on going down. The market expects that it will do so in a much more orderly way than I think will materialize, unfortunately.
Deutsche Bank says we'll get a reality check later this year. They're looking for, say, 10% downside on the S&P 500. It's not particularly unusual. Are you expecting that kind of reality check, Mohammed, anytime soon for markets, given where stocks are at all-time highs? Spreads, global credit spreads, incredibly tight.
You know, John, I'm not in the business of predicting whether it happens and when it happens. And where people have been wrong in the past, including last year, is ignoring the technicals. And the technicals right now are incredibly favorable. So the big question for me is what breaks favorable technical? By that, I mean there's still money in the sideline that can be put to work. So dips will be viewed as buying opportunities for a while. Look, John, the thing I worry about most is the sense that growth is going to disappoint with a downward risk, the balance of risk on the downside. This comes against the universal romance with the softest of all soft landing. And then secondly, a recognition that the Fed is not going to validate what's being priced in right now in terms of cuts.
When's that first rate cut coming, Mohammed?
My own gut feeling is that it will come at the beginning of the summer. So call it June, maybe July, and it will be 25 basis points. And not only do I think that that's what's going to happen, I think that that's what should happen.
That's Bloomberg opinion columnist Mohammed Al-Arian speaking there with Bloomberg's Anne-Marie Jourdain and Jonathan Ferro. Well, time for some morning calls ahead of the Asia trading day. One of last year's best wages in emerging market debt is getting a fresh boost from bets the Fed will finally begin cutting interest rates. US investment manager GMO says EM bonds are already attractive with a rich dollar, cheap currency valuations and the ongoing disinflation process. They say hints at when the easing cycle is likely to start could be a catalyst for an even stronger performance. Meanwhile, Goldman Sachs and JP Morgan are recommending borrowing the euro to buy riskier, higher-yielding currencies, and that's on the back of bets that the ECB will cut interest rates in April ahead of the Fed and the Bank of England. They say the euro's emergence as a popular funding currency may have far-reaching consequences, with traders already looking for alternatives to the yen as the funding currency of choice. All right, let's take a look at how we're doing here in Australia. The ASX been trading for 35 minutes now, and we are flat, coming back from the long weekend. We did, of course, have a public holiday here on Friday. New Zealand stocks, meanwhile, in positive territory by about 0.4%. We've got Nikkei futures looking pretty good as well. E-minis for the S&P have started trading also. They're off by about 0.25%. We did see US markets ending a little flat, a little mixed at the end of the trading week as well. Big moves in oil, though, today. Brent right now better, up by more than 1% after, of course, that attack in the Middle East. 3 US troops killed, 25 wounded on that drone strike near the Syrian border. So the oil price rising today. Well, China Evergrande Group will once again try to fend off liquidation at a court hearing that's happening later on Monday in Hong Kong. And this comes after it won a surprise reprieve in the long-running lawsuit 8 weeks ago. For more, let's bring in our Asia investing editor, Russell Ward. So, Russell, this hearing back on again. What can we expect today?
Hi, Paul. Yeah, that's the big question, whether this will finally be the hearing that results in a order for a wind-up of Evergrande. This case, as you know, has been dragging on for 18 months now, and the judge has really been losing patience with Evergrande on its lack of progress towards a restructuring plan. Remember back in September, its main plan collapsed, and its chairman, Hui Kai-yan, was detained. He's being questioned by authorities, and so since then, you know, the judge has really been saying, look, Evergrande, we need to have some concrete details on this plan. And last month's hearing in December was supposed to be, you know, the final hearing. This is the one where it's sort of last chance saloon for Evergrande. And what happened was that the original petitioner actually balked and decided it didn't want to pursue an immediate liquidation. So there was yet one more adjournment. So really now the question is like, one of the questions is, what is this petitioner going to do? Whether they will still sort of hold back, or whether even another petitioner might step in. We are hearing that one of the major creditor groups, an ad hoc group of bondholders, is considering sort of switching sides. It had been very pro-restructuring, but it's also running out of patience, we're hearing, and may end up joining the petition, which would be a really bad sign and a bad signal for convincing the judge that this restructuring plan will actually go ahead, and may persuade her to pull the trigger on a winding up order.
Yeah, and we know that the case is scheduled to be held in about 2 hours from now, but it's not just that hearing in focus, because there's also a separate one that's being held later this afternoon, and this one's a regulating order. But what exactly does that mean?
Yeah, this sort of adds an extra layer of intrigue to today's proceedings. This is a so-called regulating order hearing, which is very rare. It hasn't been used very much with the similar proceedings involving Chinese developers in Hong Kong, and it gives the court the power to appoint a liquidator. And so really this is just not a good sign ahead of this morning's hearing. It could sort of indicate that they're leaning towards, the winding up, but it just adds that extra layer of questioning over what's going to happen today, and we'll be all over it.
Russell Ward, yeah, certainly one we're going to be tracking very closely after many weeks and months of anticipation. That was our Asia investing editor there from Tokyo. And taking you now to a live shot of that Hong Kong courthouse where this liquidation, or rather that court hearing, will take place later this morning. So it's scheduled for 9:30 a.m. local time. That's just under 2 hours from now. And really watching if we start to see any sort of progress on the restructuring agreement that it's been trying to agree with creditors, but no word on that as yet either. More ahead, this is Bloomberg.
It is time for Japan Ahead on Daybreak Asia, and here are some of the stories that we are watching. Approval ratings for Japanese Prime Minister Fumio Kishida's cabinet inched higher in polls conducted by Nikkei and Mainichi. This as the Japanese leader continues to deal with the fallout from a funding scandal. Meanwhile, Nikkei reports that Japan is considering adding truck and cab drivers to the list of jobs available to foreign workers to address the country's growing labour shortage. Plus, Nikkei also says the government is planning to list their stakes in subway operator Tokyo Metro, and that'll happen later this year. Annabelle.
Yeah, well, Paul, we've also got Japanese markets coming online at the top of the next hour, so about 20 minutes out from the start of trade here. So far, we are seeing futures pointing to some modest gains at the open here, perhaps being supported in part by that Japanese yen, because you're continuing to trade around the 148 mark. Broadly, though, the context for today's session is very much going to come down to Middle Eastern tensions, because you're seeing bond futures, for instance, that are gaining there. We're seeing oil as well moving more than 1% in the early part of trade Brent crude and WTI after the US said Iranian-backed militants killed 3 service members. So it is perhaps that move slightly into more of those safe havens. But Japanese equities really on a tear so far over the course of this year. Also really key to watch for their direction this week will be earnings, because we've got Japan's top lenders due to report this week. That's after the BOJ governor, Kazuo Ueda, left little doubt that an increase of the world's last negative interest rate is in the pipeline. Bloomberg's breaking news editor Gareth Allen joins us now from Tokyo. Gareth, what can we expect to see this quarter from the bank's own operations, do you think?
Yeah, that's right. We have 2 of the 3 mega banks reporting this week. That's Sumitomo Mitsui on Thursday and Mizuho on Friday. Looking at what analysts are estimating for them, it seems that the core operations, the lending profit, fee income has been relatively solid, but they're looking to have a slightly lower net income this quarter as trading operations have been fairly difficult.
We've also got Japan's biggest brokerage, Nomura, reporting as well this week. How's their performance looking?
Yeah, Nomura looks like they're set for the full fiscal year to break out of the 3 years of declining profit that they've been mired in for the last few years. Net income set to grow by 59% according to estimates for the full year. We'll be watching to see how their renewed focus on investment management business helps them. They're looking to have that contribute 100 billion yen by 2030. They're also still constantly restructuring their wholesale business. They're looking to cut costs there, so we'll see how that's progressing. And the net income figure this year for this third quarter should give us an indication of how they're going to progress through to the end of the year.
We've seen bank stocks really sort of whipsawed a little bit in Japan with these changing expectations around what the Fed was going to be doing next. So how do you think that the BOJ policy impact will play into those numbers?
Yeah, that's right. So last week, the BOJ stood pat. Negative rates are still in place. It's completely as expected, given that the uncertainty over the impact of the earthquake, and still the BOJ wants to get some more data around how wage increases are going. Of course, the expectations now are that certainly in the first half of this year, a lot of economists are saying probably April is going to be the time that negative rates are lifted, and that's going to be a big boost for bank earnings as finally we get out of this negative interest rate world that has been so hard for banks, and they'll be able to raise rates on lending, which will give them larger margins, which of course will be positive for bank profits going forward. So as analysts have said, they're bullish on banks at the moment, and as soon as the BOJ does start to move, that's going to help stock prices, help earnings for Japanese banks going forward.
All right, breaking news editor Gareth Allen in Tokyo there. Well, Morgan Stanley MUFG predicts the Bank of Japan will scrap the world's last sub-zero interest rate policy in March after more hawkish signs emerged from the BOJ's Outlook report. And the group's chief Japan economist Takeshi Yamaguchi joins us now from Tokyo. Thanks so much for joining us. I want to talk a little bit more about that call. You're not alone, of course, in seeing the BOJ ending negative rates in March, but it's one thing to get to zero. How far beyond zero do you see the BOJ potentially going, if at all?
Yes, so we expect BOJ to get rid of the negative interest rate policy and the YCC at the March monetary policy meeting. April is a risk scenario, but our impression from Governor Ueda's press conference and the Outlook report is that the BOJ is increasingly confident about the sustainability of inflation and wage growth. And after getting rid of the negative interest rate policy, we expect one additional rate hike in July by 25 basis points from 0 to 0.25%. And that's as far as BOJ can go in our forecast.
Mm-hmm. With inflation, though, we did see a miss from Tokyo CPI last week. How sustainable do you see this 2% inflation target for the BOJ being? And could you see a scenario where they end up having to ease again?
I think Tokyo CPI is a bit misleading in the sense that it was affected by a decline in energy prices and food inflation, but also several one-off factors played a role, such as the volatile hotel charges. So I think BOJ, tends to get rid of these temporary factors, and they look at the underlying inflation trend, and especially the service component. If you look at the PPI services, it still remain high on the back of solid wage growth. So we think underlying inflation trend is still resilient, and we don't expect any additional rate cut or other easing measures in the near term.
And you mentioned wage growth there. Of course, a critical piece to this puzzle is the Shunto spring wage negotiations. What are your expectations?
Yeah, so the first results will be released by mid-March, in which we expect around 4% headline wage increase versus 3.6, 3.7% wage increase last year. So this is mainly about large companies, but Governor Ueda already made it clear that the BOJ will be able to make a decision without waiting for the whole results of the spring wage negotiations, including smaller companies. So that's why we expect an early move by the BOJ in the March monetary policy meeting.
Yeah, can you just give us more context on that? Because a lot of, or the majority of economists that we hear from are actually expecting April following the outcome of those wage negotiations. So what is it about March that you think is the reason they should be lifting rates at that point in time?
Mm-hmm. Yeah, so BOJ publishes quarterly outlook report in the April monetary policy meeting. So yes, April is also our risk scenario, but we attach slightly higher probability to the March meeting because the spring wage negotiation results will be released before the March meeting. Also, BOJ can check the aggregated profits of smaller companies by the Ministry of Finance's corporate statistics, which will be released in early March. Also, I think Ueda-san has a track record of moving earlier than market expectations. For example, last July, BOJ adjusted YCC. We had expected, yes, YCC adjustment, but I think at that time, the consensus was no change, policy change. Ueda-san did again in October. So our impression is that I think BOJ is ready to act already. So that's why we attach slightly higher probability to the March policy meeting.
I'm curious what you think about Kazueda's performance so far, given he's about 9 months rather now into his term there. Do you think his communication style has changed at all?
Yes, I think there's some uncertainty or some debates among investors about the way Ueda-san communicates, especially his challenging comment last year. But I think he clearly laid out how BOJ normalized policy at the January monetary policy meeting. So I think our impression is, judging from Governor Ueda's press conference, also the outlook report, I think BOJ is ready to act right now.
Okay, I just want to quickly get your view on the yen as well. It's looking pretty weak again at 148.13. But this weekend it's been pushing up the price of imports. Can you foresee the direction of the yen changing as monetary policy for Japan and the US begin to diverge?
Yes, our house view of the dollar yen is 140 at the end of this year. That's forecast by our FX team. And I think, yes, we do expect BOJ to get rid of the negative interest rate policy in the spring, followed by 25 basis point in July, hike in July. So that forecast seems in line with our BOJ call.
That was Takeshi Yamaguchi, Chief Japan Economist at Morgan Stanley, joining us there from Tokyo. And you can catch Japan Ahead every week. That's on Monday at 8:40 a.m. if you're watching in Tokyo, 7:40 p.m. Sunday in New York. Bloomberg subscribers can watch us live on the terminal using the TV Go function. This is Bloomberg.
Well, we've got to talk about it, Annabelle. The Aussie Open is all over, and we've got a new champion, Jannik Sinner. What a match it was. I know that you must have watched it, coming back from those 2 sets down to defeat Daniel Medvedev. But you've really got a feel for poor old Daniel Medvedev there. He's been 6 Grand Slam finals now, and he's lost 5.
Yeah, that's right. And actually, it's his 3rd time that he's been in the Australian Open where he hasn't managed to clinch any sort of victory. But yes, Paul, to answer your question, I did watch every single set last night over that. Really a very thrilling game because we came into it and Medvedev really convincingly took those first 2 sets. He was playing a lot better than he had in his prior performance against Zverev, his German counterpart. But last night, it was that direction that started to finally shift in the 3rd set, and Sinner taking that, and you just saw him come back into the 4th set a lot more convinced in his capabilities, and he really just drove it home. It's been an incredible start to the year for Sinner, who really capped off as well at the end of last year some really key victories and key defeats against the likes of Djokovic, for instance. A lot of people didn't realise that, yes, he defeated Djokovic at the Australian Open, but actually the last 3 times he'd played Djokovic, he'd already beat him as well.
Yeah, and that semi-final was, of course, critical in this victory. But he's got a long way to go, doesn't he, before he beats Djokovic's record at the Aussie Open. I think he's got to collect 9 more titles to equal Djokovic's record of 10. But could be maybe we're seeing a changing of the guard after a very long time in men's tennis, Bell.
Yeah, that's right. That's really what it seems like. At 22 years old, he's got quite a lot of time left in the tank, joining the likes of Alcaraz as well. Not his best start to the year, but still very, very interesting 2 weeks at the Australian Open. Coming up, though, in the next hour, more on markets, because Lombard Odier tells us why they think China's latest stimulus measures are not game changers. Plus, we discuss mounting stress in the mainland banking and property sector with Jefferies. The market opens in Seoul or Tokyo, and next, this is Bloomberg.